fundamental thing to understanding your valuation, right? You've got the cash generating power, and then you've got the risk attached to that, to the ability to generate those cash. It's a shame that people define their success by their exit. It's about the person that you become in growing a business.
What one key piece of advice would you like to give to all the entrepreneurs watching and listening today?
There's inherent value in working with someone who's been there and done that, and can show you the way.
Hey, and welcome to another episode of the Business Growth Show. I'm your host, Casiotis, and today I have an awesome guest. His name is Saul Cohen, and he is an experienced accountant and acquisitions advisor, passionate about helping entrepreneurs achieve financial growth through strategic acquisitions and insightful financial planning. And having supported over 100 acquisitions, Saul brings a wealth of expertise in guiding business owners through complex transactions, and with a background at firms like PwC and BT, and having worked with clients such as JP Morgan, EasyJet, and Tesco, he offers insight across multiple industries, and he's particularly dedicated to assisting business owners who feel stuck, providing guidance on tax planning, exit strategies, and acquisitions to ensure long-term financial success. Saul helps entrepreneurs shift from day-to-day operators to thinking like investors, maximizing both business value and personal wealth, and his unique perspective and creative approach to accounting make him a valuable resource for planning future growth while optimizing current operations. Welcome, Saul Cohen, and thank you for being on the Business Growth Show.
Thank you for having me on.
Awesome, mate. I'm sure it's going to be a great podcast episode for everyone watching and listening today. And you are a successful entrepreneur. So yeah, for those people who don't know who you are, just introduce yourself by telling us a little bit more about you and your journey.
Sure. Yeah. So, I've always loved entrepreneurship. I remember, so my dad was sort of a solopreneur. He ran his own business, and what I would say is probably that a great lifestyle business. And it really sort of ignited that flair for me. And so when I was at uni, I was probably sick of education at that point, and I was just feeling like, I'm just wasting my life here. And I started my first business there. That was great. It was just like it wasn't really, and I mean, looking back on it, it wasn't really a serious business. It could have been, but just, I wasn't the person then to make it successful. But I definitely learned a lot. I did it with a partner. Eventually, we sort of sold it out for a small number, but it was good just to get a view of what that process looks like, and start understanding. Actually, valuations aren't really what you think they are. And then I went to PwC, loved it, got really like sort of swamped in this corporate world. I really didn't know what I wanted to do, and I ended up becoming an accountant because I wanted to work with as many different types of businesses as I could. I just sort of loved being around entrepreneurs. And at PwC, it's funny because I didn't get any of that, being with entrepreneurs. I was working with sort of stakeholders, and it's much more corporate, and it's great because it was a fantastic place to work, very hard, but fantastic. Um, but yeah, it just didn't give me that sort of that spark of working with entrepreneurs and that fulfillment, I think. And basically my dad got ill, had to sell his company, and I just like it sort of re-sparked that passion in me, and I was like, I want to help people like him. He's done great, but yeah, he could have done even better. And I really want to go out there, and I'm sure there are other guys like that. And actually go out and you see there are loads of fantastic entrepreneurs, business owners. They work really hard, and it's just a shame because they don't get they don't get the same level of advice. And instead of being here, they end up here. And I just think that's a shame. And so I started out with the view of helping entrepreneurs get the reward that they deserve for their hard work and efforts. And yeah, I mean, I love entrepreneurship. I think that generally it's that creativity and ingenuity that really changes the world and has brought the world forward. It's always politicians think it's them, but it's not them. It's the entrepreneurs in the world. And I love being a part of that journey, and that's really what gets me up in the morning. Yeah, and keeps me going.
Yeah, awesome, mate. Love the journey and hearing, about how it all started, the early stage businesses, and your dad, and how that sparked, that passion for what you do now is really powerful. And yeah, let's get into it. So I know you talk a lot about transitioning from a business operator to a strategic investor. It reminds me a little bit about Robert Kiyosaki and the cash flow quadrant, so to
Yeah.
speak, there, which is very important. One of my first initial books that I read in my business. And I guess let's start from the beginning, right? Because some people need to start it. So, what are some of the key steps an entrepreneur should take when they're transitioning? I guess from being that day-to-day operator to adopting a more strategic, investor focused mindset.
Okay, so I'm gonna talk to the successful entrepreneur, so the entrepreneur who's ready to make that step, because I think when you're really at the foundation stages, you're really still an employee, then you're basically a managing director, and then you move into CEO, and then you're moving really into investor. And I think that really the point to start thinking of your business as an investor um, is as early as possible, right? Despite the fact that I've just sort of said, you take all those steps. And I think the first thing that every business owner should do is set aside a period of time. At the beginning, it's a much smaller period of time. Um, I think for me, it was maybe once every 3 months. Um, but as you develop as a business owner, you want to make that time more regular. So now I take a day out every month. And I think any successful business owner who is at that point where they really need to start thinking as an investor. So let's say you've hit sort of, you've got to the point. I'm defining successful business owner as you've got to the point where your business is generating profits in excess of your need to live, right? Um, and perhaps you've definitely you've got a team of 8 people or more, right? So that's what I'm picturing when I say successful business owner, right? You've got a real tangible asset. um, and I think for those people, taking the first step is always to take a day of month out of the business. And it's not to sit on holiday. It's like you're working on the business, and you look at the business. You ask some strategic questions about the business. Like a SWOT analysis, right? What are our strengths? What are our weaknesses? What do we do well? Where are our opportunities? Where are our threats? What could we do better? And then you might also once a quarter want to do that with your team and run that as a group exercise and get feedback from people in your team. But I think the most important point, the fundamental mindset shift, comes from when you start taking yourself out deliberately, like physically taking yourself out, um, and asking yourselves those questions that a real investor would.
Yeah,
Yeah,
I love it, mate. It's so powerful, and I that's what I find as well with the clients that I work with is that it's like that mindset of no one can do it as well as me, right?
yeah,
which is true because we're all unique, right? No one's ever going to do it as well as you. So you've just got to be okay with as you build that team, going, how can I find someone in here that can run it as best as possible, so that I can do other things, right? On that I
yeah.
want to be doing in that way as well, yeah. And I guess when you start to get to that bigger level where you've got that team in place, it's letting go, right, of that area there without wanting to play the game and going, there's a bigger game to play, right? Is that sort of the level of thinking, I guess, to start moving into that investor side?
Yeah, I mean, it's as I say, it's just thinking like taking yourself completely out and saying, looking almost separating your day to day from your position as a business owner, and looking at that business and trying to look at it as a third party would, and saying, if I was to come and buy this business, what would I do? If I were to, what's our next step in the business that's really going to move the needle? Um, I don't think that I think lots of business owners don't really do that. They don't ask those questions because you get very focused in day to day, right? Um,
Definitely. And this is
and
where people like
yeah,
you, right? And external people come in, right? Because it's hard to do it necessarily on your own. You know what I mean? In
yeah,
that way.
yeah,
Because as the entrepreneur, we're not accountable to anybody, right? You can do what you want.
yeah. So look, the truth is, it's like it's a fantastic thing to do with if you've got a business coach, or if you've got like you're an accountant, or if you've got like sort of a non-executive director, it's a fantastic thing to do with them because they're already in that mindset of being sort of outside the business, but understand your business enough um, to be able to sort of sit there and be a good sounding board. But and lots of our clients do it on their own. They just go out and just really reflect, change the scenery. They go somewhere nice, sort of raise their vibration or whatever it is, just being in a good environment and start thinking from a place of abundance and thinking, what do I really want in my life? What does my business need to achieve? You know, where is this business? What are the weaknesses in that business? What are the strengths in that business? What do we need to do in the next 3 months or 6 months or whatever to sort of remediate those weaknesses, take advantage of the opportunities that we've got available to us? Honestly, I think just doing that, asking ourselves those questions in a place that isn't in your normal standard day-to-day office, I think, yeah, that's the first step in shifting that mindset to an investor.
Yeah, I love it. And then the creativity juices, start flowing and everything like that there.
Absolutely.
And then it's really powerful. So I love that. Yeah, getting outside of the standard place and allowing that to happen, mate. So yeah, awesome stuff there. You talked before about valuations, right? About that they're not always the way that they are, and it's always interesting, right? And a lot of people, obviously, if they're looking for an exit, they might be trying to maximize a valuation, but there might be some
Yeah,
issues or things that they're not aware of, right? When trying to
yeah.
do that. So do you want to maybe talk about some of these challenges and what people should be watching out for?
Yeah, so actually, it's really interesting because I think that the process to exit, and I'll talk about this just really quickly. The process to exit is really different depending on the type of business that you're in. And Dan Priestley talks about this idea of you've got like sort of a lifestyle business and then a scale up business, right? And there's two very distinct things that we're building. And the truth is the way those businesses are valued is different as well. Right, because in a lifestyle business, the assets that you've built are much more tangible. They sit on the business. Maybe they sit on the balance sheet. They have a real value that is sold, that is saleable. Whereas in a scale-up business, we have like real tangible assets that are valuable and scalable and saleable. We've got those assets that sit on a balance sheet. But in a lifestyle business, um, you will definitely still have assets. You just won't have as much, and it does make it harder to sell the business. So, I mean, we can come back to that, but the main thing to answer your question about valuation is to understand that there's two real critical points to a valuation, right? What investors really buying is the future cash flow of your business. Okay, and so we look at we assess the future cash flow in your business most commonly by saying, this is your profit, and here's a multiple that we attach to that. But what we're really saying behind it is, this is the cash flow generating power of your business. Your business is able to generate X 100,000 a year. And this is the risk portfolio that we're attaching to your business, right? So the multiple is dependent on the risk that your business poses to a third party buying your business. So if we've got, for example, actually a great example, I met someone 2 days ago looking to sell their business, fantastic business in sort of the interior design space, making maybe £6 million revenue a year, 1.2 million pounds in profit, like genuinely a good business. They've got great reputation. It's all high-end stuff, and they've been growing, maybe 50% or 30% a year, I should say, for the last few years. And, you can really see they're on a great journey. The problem is that the current owners are 100% of the design and, what the special spark on that business. And so if you're a third party looking to buy this business, I've got fantastic cash generating power, but my faith that cash generating power is going to continue in the 12 months prior to the current owner leaving is next to nil. And so I've got this amazing business that, if it wasn't dependent on the owner, would probably be worth 5-6 times multiple. But now is probably going to be worth maybe 2 times multiple, if that, because it's so risky where it's at. Um, and I think that's the understanding that is like the fundamental thing to understanding your valuation, right? It's you've got the cash generating power, and then you've got the risk attached to that, to the ability to generate those cash.
Yeah, great points. And everything's a little bit different, right? As you said, and depending on how much, because from my understanding as well, right? Like obviously, that's one area is how attached the owner is, right, to it, and then how much less risk there is. The other part is then what is the level of net profit or EBITDA, whatever words we want to use, right? That is the multiple. What level are they at? Because the higher that goes, then the multiple goes higher, right? As well, in that way
Yeah, but I
there.
mean, ask yourself why. The reason why when the multiple when the profit goes up, the multiple goes up, is because there's an assumption that the bigger the business is, the less risky it is, because there's less chance of costs changing and fluctuations. There's less chance of big revenue drop-offs, right? So if I've got a business that's generating $100,000 or pounds or whatever it is in free flowing cash flow, call it EBITDA or whatever it is, right? And it's generating that every year. That's inherently more risky than a business that's generating 10 million pounds or dollars in EBITDA, because the $10 million business has much more scope to drop off a little bit and not kill my entire return. Whereas the $100,000 business, if it loses one big customer, could lose everything. And that's why. So the bigger businesses are inherently less risky. So the reason why the multipliers change and get bigger as your EBIT gets bigger, as your earnings get bigger, is because of that. Is because there is a perception that the business is less risky.
Yeah, no, I love it, mate. So powerful. And so if we're wanting to really maximize that, right? Like, let's say we're thinking about the exit. Hopefully, we're building it from the start, like you said, right, to get ourselves out of the business. But if we're really wanting to get that biggest valuation and an exit opportunity, from a financial planning and everything perspective here, like what can we do, to ensure that we're on the right path there?
So the first thing to do, I think, is to check that you really do want that, because I think a lot of business owners, that business we all do this, right? We all say that what we want is scale up business that's saleable. We all say that we want to do that, but when we actually think about what's required of us to get to that point, I don't know that all of us really do want a business that's massively saleable and is going to be fantastically valuable on exit. I think lots of business owners, really just want a fantastic lifestyle business, like the interior design business that I just described, right? It's making really good profits, gives the owner lots of flexibility, but, it's not saleable for one reason or another. Um, and sure, when I say not saleable, I don't mean you won't find a buyer at all. What I mean is that you're not going to get the same valuation that you would if it was a scale up business and if it was less risky and you'd put in the work to reduce the risk portfolio for an investor. Um, you know, uh, and and the reason why I think it's different is because I think the exit strategies are different. I think if you've got a lifestyle business, the exit strategy is okay, great. Let's prioritize tax planning and extraction from the business. And over a period of 10, 15, 20 years, we'll build you assets outside the business so that you're basically your lump sum, your reward at the end of it is the assets that you've built over a period of 20 years. But if you're reinvesting into the business and you're building this sort of scale up business, you might still be taking out stuff on the side, but you will be taking out less because you'll be reinvesting heavily into building the asset that is your business. And so the first step is always to make that decision that you really want to do it, because some of these things, I don't need to tell you, like, how hard is building a team? Right? Yeah. How hard is like setting processes and systems that actually work and building a culture, and like it is hard, right? There's no way around it. Um, and you need to do all those things because that's what an investor is going to be looking for. So the first step is always going to be to decide that you want that. And then the second step is going to be to as I say, take that time out and think, what's the next thing that an investor would be looking for in my business? What are the key risks to my business? Probably no one knows them better than you as a business owner. What are the key risks and how are you going to mitigate them? And it really is as simple as that. In most cases, it's owner dependency, but in lots of cases, it's, um, revenue, quality of revenue is just not that great. Or maybe you're heavily reliant on certain suppliers, or there's a whole host of risks. Maybe you're not, your employees are not loyal, and there's a lot of employee churn and turnover. Um, and it might be the sort of thing that you want to have a discussion with an advisor about. Say, you know, help me work out this is what I think the risks are. What would you say as a third party who come into my business, and if you were doing due diligence, for example, on my business, what would you say are the big risks? But yeah, I think the first step, really, the fundamental, is to decide that you want to do that and invest in your business, and get it to the point where it is saleable. And if you've decided that, I think it could be done in 2-3 years.
Yeah, awesome. It's interesting. One thing I'd like to know your opinion on is that in Australia right now, there's a lot like the baby boomers, are sort of getting to retirement age, right? So there's a
Yeah,
lot more, and the kids are wanting to be, doing their own thing. They're not necessarily wanting to take over the family business. There's all these things happening. So it's a bit of a wealth transfer. But then if they've worked in this business and they're the operator, right? Some of these businesses aren't saleable. So there's a lot of like, businesses out there, but how many of them actually getting? And a lot of them are just closing down or things like that. I'm not sure if there's similar things happening in the UK as well. And I guess, yeah, what that situation is for an investor and going, well, it's almost changing the perception of what these people think that they're going to get for their business, or are they going to be able to change and you know what I mean, and move on, like those motivating factors as well.
yeah. I think that's what my view is, that most of the time the reason why businesses close down instead of sell has nothing or very little to do with the fact that you can't find a buyer, and more to do with the fact that you can't find a buyer at the price you want to sell at. And I think that part of the problem is that business owners, they define their success of their entire career on their exit. And actually, as I said, if you've built a lifestyle business and you've built assets outside of that, and you've thought about this and planned it, it doesn't need to be defined on that one moment. It's defined on your career. And the truth is, if you've built a successful business, you're already in the minority. Um, you know, but most businesses don't work. I think I can't remember the stats, but it's a small fraction. It's maybe only 1 or 2% that get to that 1-2 million mark in revenue. And if you think about it like that, you are incredibly successful. You're incredible for what you do. You're incredibly unique. There's a reason why no one can do what you do, as you said, right? And it's a shame that people define their success by their exit, because I think if people were more malleable with their exit options, they would not, and where people are more malleable and more flexible about, actually, maybe let's just do a profit share for a few years, and I'm gonna I'm gonna I'm gonna close this thing up anyway, so I'll take whatever number you want to give me, type thing. I think normally that's where the best deals come out. And we can normally get something that works for both parties. I think it's the opportunity of our generation, for like the younger generation now coming up. This is like the wealth transfer for entrepreneurs. And this is where, you know why start a business when you could buy one? We're hearing that more and more. I think in the UK we've got 200,000 businesses, or 200,000 business owners are approaching retirement age in the next 5 years. That's a massive. It's an economic cliff face if there aren't entrepreneurs to come in and buy those businesses. But yeah, I think there needs to be a bit of a mindset shift, and an acceptance that, I'm either going to put in the work and sell to a different class of owner, a family office or private equity or whatever it is, or I'm going to have a lifestyle business. I know I've got a lifestyle business, and then I'm going to sell out to someone on maybe some really flexible terms and give someone else a step up, and know that my legacy is protected, and I'll get paid for another 5 years or whatever it is that you can agree. So
Yeah.
yeah, I think that yeah.
Yeah, I love that, mate. That's so true. That distinction there of what people want, that price and what they want. And I know someone recently that, he got an offer for multiple millions, right, for his business, and he didn't take it, right, at the time. And this is where like the timing happens. And now the business is not doing as well, right? So
Yeah.
now it becomes even more challenging, right? Because then you got to try and get it up to that point, and then going, well, there's more risk. You're probably not going to get the original price, you know what I mean, that you wanted for a while for it, unless you really, scale it or make it up really a lot more. So it's like knowing when to sell as well, because if you hold out too long and trying to get more, it may never happen at the same time. So I think you raised a great point in just going, listen, depending on how you've structured it, is if you've got some decent offers, you can be flexible on the terms. Is look at it, because you may shoot yourself in the foot, so to speak as
Yeah.
well. So yeah, I love that, mate. Really, really great points. So let's shift now and talk more around scaling a business. And I know you talk a lot about doing this through acquisitions, right? So mergers and acquisitions, obviously, it's a big one for growth. I'm looking at acquiring businesses myself as well, so I love this space. So initially, if people are looking to do this, right, they're small business owners, entrepreneurs, and at that business, what are some of the steps that they should take to look at this, I guess, as a strategy for their business growth?
uh, just get started. Um, yeah, look, I love the acquisition space. Um, as I said before, why grow a business when you want to start one? To me, actually, the answer to that question is it's about the person that you become in growing a business, um, and the person that you need to be and develop into. And I think that puts you in a much better mindset, and it gives you a skill set that you won't have um, otherwise. And therefore, when you do come to make acquisitions, you are more prepared for it. Um, the worst acquisition you ever make will be your first. And I think it's true with everything, right? The worst video you ever do will be your first, and it's one of those things where you kind of just need to get the first one over the line, and you'll learn so much from it. Definitely educate yourself. Definitely speak to people who've done it in the space. If you've got advisors, or someone, you've got business friends who have bought businesses before. Talk to them. Understand what they've done. What pitfalls they've had, but it's not foolproof, and nothing in life teaches like experience. And just get out there and do it. What I would say is that you want your first one to be as yeah as less risky as possible. So if you can, your first one should be a no money down deal, or something close to where you're putting in a bit of a much smaller percentage up front, and maybe you're leveraging it, and you're putting it off, you've hived it down, it's somewhere separate. It's not going to kill everything if it didn't work out. That's what I would say. But I think it's a fantastic strategy, and definitely, it's the sort of thing that the more you do it, the better you get.
Yeah. Awesome, mate. Love it. Definitely true on that one about just getting your hands dirty, right? Say yes, work out how after, and then you work on, fixing it from when you go through that process. I guess there's challenges, right? Because when you're looking at other businesses, someone else has built it, they build a particular culture, the values, the vision, and you want to integrate this, right, into your
Yeah.
business here. So what are some of these areas here, right? Or what we're doing or we're acquiring this, of what we need to do, right? To make sure it's as smooth, as possible.
Well, look, I think actually with this, it's probably best to talk it through like with examples. So, you said you're looking at buying businesses. So what type of businesses are you looking at?
Yeah. So for me, I'm keeping a bit more industry agnostic, but I'm looking for going concerns, which to everybody means that they're profitable businesses, right?
Yeah.
And they're not concerning. That's actually a good thing. And from there, I'm looking at now. I'm a bit more open, right, to what people do. So I could say, maybe at least they're making, 100 grand in EBITDA net profit, I'm okay with, but they could be in the millions, right? As well in doing that. So I'm open to having a lot of businesses, not just one, right? And going like that. So I'm looking at more of building many businesses around me. So
Yeah,
I'm a little bit different in terms of what I'm doing there, where some people might be going, I want to acquire a similar business to what I'm doing and doing it like that.
yeah.
Whereas for me, I'm acquiring a lot of different businesses. So for me, what I'm looking at is going, okay, yeah, how is the owner involved in this? Or can I then, because I'm not going to be the one necessarily running it, right? Because I'm coming from an investor. So can I put in a general manager or some sort, someone to run that business, especially if it's a lifestyle business or something like that
Yeah.
there, that I can then be on the outside. There's enough profit in there to be able to do that, help the transition, and use my skills with my partners to then continue to grow the business, obviously, like that as well. So that's the way that I look at it. Yeah.
Okay, fine. So yeah, I mean, look, and I do think that's really important to understand what personality, what persona you're taking when you buy that business, because it changes it, right? If you're buying it as a strategic investor, it is a little bit different to buying it as a personal investor or an yeah, private investor is sort of more what you're looking to do. Um, yeah, so okay, so if we're looking at someone who's buying it on to bolt to their business, um, I think the number one thing to understand is what the again it is actually asking the question, what particular element of this new business are they buying? Are they buying an additional revenue, so access to a new market? Are they buying access to new suppliers? Is it industry know-how that's in that business that they don't have? What exact element are they buying? Um, and what's the culture like in that business? Because I think in strategic purchases, the biggest reason that they don't work post acquisition is cultural clashes that happen. Um, we work with a fantastic. We don't really work with business brokers. They've not got the best reputation, but we do work with a fantastic. They call themselves business consultants, but essentially they fill the role of a broker. And one of the things that they always say is that business acquisitions is 80% heart and 20% financials. And actually, do you know what? Particularly when it comes to these sort of strategic purchases, it is literally 80% heart. If it's going to work, it will be because the cultures work, the values in the organizations are, aligned. And that is really important because if you're buying a business to bolt onto your existing one and you want that bolt on to happen quickly and you're not, if you're patient, then it's completely different. But if you want it to happen quickly and those businesses to come together and work together as one, the cultural piece will be really painful if you're not aligned on cultures and values.
Yeah, love it, mate. So true. And yeah, working together and putting that in is really, what it's all about, like you said there. So let's talk like a bit next level stuff here now, right? So, what I know as strategies and looking at doing myself as well is talking about things like roll-ups, right? So
Yeah,
this is where we for everyone that doesn't know what we're talking about, is about acquiring a lot of businesses and putting them together that are similar, right? So let's say, you've got an accounting practice. Let's just keep it simple, right? You acquire 5 other accounting practices that might be similar in a smaller size, but when you put them together, yes, you have to do the whole piece that you're talking about, but then the valuation is a lot more, right? Because now the profit and multiple, the cash flow is a lot higher. Then it allows for growth, right? To be able to get a
yeah.
bigger exit strategy. So is this something that you're thinking about, and do you have any thoughts around how to make that, I guess, as smooth as possible?
Yeah, look, so lots of our clients are doing roll-ups. I personally haven't done them yet because, well, I think they're great, but I just think it takes a lot of time and headspace, or more than sometimes people think. Um, but I think a lot of our clients are doing it, and they're doing it really well. And what they do with it, as you say, exactly as you say, right? So what you're buying, um, let's say you've got mom and pop businesses, maybe making £1 million a year top line revenue, and then £100,000 profit. One of them is maybe worth £150,000. It's not a lot of money, and if you can buy 20 of them, right, and you maybe buy them and you put them together just before you've done anything, just having 20 of them with £2 million in EBITDA now, that is inherently, as you say, inherently more valuable. What most people will do though, because having 20 independent businesses running together under the same roof is near enough impossible. What most people do is they sort of group them together. And the way that I've seen it done most successfully is when it's done a little bit more gradually. I have had, I mean, I've seen people do this really, really quickly. I worked with a client a few years ago who literally, I think they were making about 30 or 40 acquisitions a year. Um, and they very quickly became the fastest one, but they forget being the fastest growing. They were one of like the top five nursery groups in the UK, like from nothing to top five. Um, and but I think that's really painful, and that it comes with all sorts of issues that you need to sort along the way. And I think what's actually much more stable is to do it a little bit more gradually. Um, you might be a really impatient entrepreneur and you want to go pedal to the metal and do it and be my guest. But if you're going to do that, be aware that you're going to have cultural issues in the organization that you're going to need to sort of train in, and people don't change overnight. You're going to have cash flow problems because you're moving a business over a mountain, to like, you're just sort of pushing it forward and pushing it together. And that pressure causes issues and it causes things to bubble to the surface. So I think generally it's done much better when it's a little bit more gradual. The acquisitions are a little bit more strategic. So let's say, for example, let's say, in your accountancy example, right? You've got an accountancy business that works there. Your first one might be I'm just going to do this for economies of scale, right? I'm going to buy a bigger accountancy practice with additional revenue streams, additional income, and we're just going to come in, we're going to take out the back end of both of them. We're going to make a head office function, put marketing in there, and then, we can do all of that at the back end. And because we're doing it for two businesses instead of one, it's going to be more effective, and basically cheaper overall. And then you say the next one, well, actually, what this business is lacking is a tax specialism. So why don't we go out and look for specialist tax consultants? And so you go out and buy specialist tax consultants, and because now you're cross-selling, and you've got this, the sum of the parts is the sum of the whole is bigger than the value of the parts. And then you go out and maybe you buy business restructuring consultants, and then you've got, essentially, before you know it, you've got a whole professional services brand, and it's much bigger, and you're cross-selling into each other, and the whole thing. It's not just about saying I've got this bottom line and we just added on the bottom line. It's much bigger than that. You've got new access to different markets that you wouldn't have had. You've got access to suppliers, know-how, that you wouldn't have had. And if the culture's there and it is, you've done, it's going to be important to do team days and bring everyone together and, have that sort of the heart piece as well, then that business is going to be, it's not just going to be maybe 5 times multiple or 6 times multiple or even like 8 times multiple. It could be a lot more because it's inherently, it lives, breathes, grows on its own, and therefore it is a true asset of value with fairly low risk.
Yeah, awesome, mate. Love it. And I guess just one more right thing on that. So, because a lot of people are, may be thinking, hey, yeah, but I don't have all this cash, to buy these businesses or everything like that, right? Because you've only got a certain amount. And yes, there's ways of structuring the deals, like you said, for a little to no money down or things like that. I guess it's also maybe looking at other partners or people that can come into this, right? Whether it's capital partners or other people to do that. So, do you want to maybe talk about elements of like that it's possible in different ways, either by yourself or with other people around you, so you can actually, get these over the line and not necessarily all being you doing it. Yeah.
Yeah. Look, I think the thing is that as I sort of mentioned, it's that most of business acquisition is about heart. And at the end of the day, particularly if you don't have any money, if I didn't have any money, and I was looking at making a business acquisition, I would approach maybe, 5, 10 business entrepreneurs, build a relationship with them who are maybe approaching retirement, look to build a relationship with them. And you mention it, you don't, it's not like a cynical thing where you say, oh yeah, look, um, you build a relationship with them and sort of try and hoodwink them into buying a business. No, you say it straight up, like, I'm looking to buy a business. Um, that's what I want to do. This is what I'm doing. What would your advice be about business? And go through. And people, when they want to sell their business and they see someone who's on the up and someone that they want to support, most business owners are thinking about, you know, legacy and again, particularly when they're looking to close off the lights, switch off the lights and just shut down. If they've got someone in their network who they really believe in, they'd be willing to do a deal with them because again, this comes back to what I was saying right at the beginning. The reason I love working with business owners is that they are people who come from a place of abundance. They want to give. They don't just want to, they're not just in it to take. They want to give to society. They want to impact the world. And if they find someone that they really believe in, then, and, they've got a good, emotional rapport with, doesn't even have to be someone they've known for years or whatever. It's just someone that they really can see would look after their business and do their best and grow into the business and maybe have a fresh take and all of those things. Then they would be willing to have a discussion. And I think that when you remember that the alternative for most businesses, 80% of business, 80 to 80% of businesses don't sell, they just switch off the lights. And when you remember that, you go in with the confidence of knowing that there are loads of really good businesses that are just going to close down. And if you're willing to put in the work, you will have opportunities with them. Um, and I've seen it. I've seen it happen. I've seen a guy, through doing this sort of thing and agreeing with a business owner, listen, I'll just split 50 profits with you for the next 5 years. You take whatever you've earned up until now. Obviously, that's your money. You take that out, and that would be part of your sort of acquisition. That's your sort of lump sum payment, your upfront payment. And then I'll pay you 50% of profit for the next 5 years, 8 years. I've never seen it longer than 8 years. But I mean, for a business owner who's looking to retire, that's like a golden opportunity, to have someone that they believe in and maybe mentor and whatever, and then also get 50% of their profits for the next 5 years when they were going to close down. Like, Alex Hormozy talks about, you know, uh, offers, right? Offers so good that people can't say no. That's an offer so good I can't say no. My alternative is closing down my business, and now you've given me a way to maintain 50% of profits for the next 5 years, right? Most people think of it the other way. They say, why would someone give me their business for free when they can earn 100% of profits by working in it? And what they forget is they don't want to work in it anymore. That's not an option. They're going to close it down. And so you're giving them a way to earn 50%. Of 50% of something is better than 100% of nothing, right? And that's the option that a retiring business owner who can't sell their business is in. And so yeah, there's plenty of options. And that I haven't even spoken right there about taking out finance and buying them out 100%, or buying out partially and then having options to buy out another 20%. And there's tons. We could do several podcasts just on the ways in which you can buy a business without spending money. So yeah, absolutely, it's possible. There's so many ways, but I think the first step is really about building the relationships and having a reputation in the market and demonstrating that maturity that you are sort of ready to be a business owner, if you're not, or you're ready to be a business investor, if you are already a business owner, that you're ready to be that sort of person that someone can rely on to maintain their legacy.
Yeah, I love that point. Just show what's possible. There's so many different ways there, guys. So it's just getting out there and doing it, as you're talking about. So so much value, man, that you've shared with us today. And I guess as we're starting to wrap up, what one key piece of advice would you like to give to all the entrepreneurs watching and listening today?
I think listen, entrepreneurship's hard. No one teaches us how to do it, and most of us muddle through. And I think that because of that, no one teaches us how to do entrepreneurship. There's so much that we don't know. Um, and the thing that I've learned personally, when I work with a business coach, fantastic business coach, and what I've learned from working with a business coach is that there's inherent value in working with someone who's been there and done that, and can show you the way, and point out the pitfalls and shine up a mirror to you. And the thing is that is also true for other areas of business, like finances. And there's so much that you don't know, and you don't even know to ask the questions. And asking those questions about exit and saying, what does my exit really look like from a specialist, right? Because not everyone is, but asking those questions and planning it out will mean the difference between you in retirement living a comfortable life or a luxurious life, whatever that is for you, depending on where you're at. But it will be the difference between comfort and luxury. And I think most business owners deserve luxury but end up with comfort. And I think that is a bit of a shame. And I think, my sort of mission is to make sure that everyone gets a luxurious life at the end of it.
Yeah, awesome, mate. So true. Love all of that points. And yeah, external people, coaches, financial advisors, all of these things like yourself, myself, that we're here to help, right? To people to get them to
Absolutely.
where they want to be faster and bigger and better. So love it. And yeah, we connected through our networks. I learned about your awesome journey from your various roles in management consulting, auditing, accounting and finance, and now being a partner at, the Expert Eye. You're an awesome guy, mate. Shared so much knowledge here today on what's possible to get entrepreneurs to that proper business wise acquisitions, all those areas there, to that investor mindset. I'm sure you continue to provide guidance on tax planning, exit strategies, and acquisitions to ensure long-term financial success. Very grateful that we connected, and look forward to connecting further, mate. So how can people find you and get in contact with you?
Yeah, so I think look, if you just want more sort of tips and stuff, I post sort of daily on LinkedIn, so that's definitely the best way. But I'm also and I'll give you the link for this. I'm currently writing a book, and I've got a wait list for that book, and we're probably going to do some promotions to the wait list. Maybe even give out some free copies. So I'm writing a book all on exit strategies and how to prep your book for exit and the steps to take, depending on what route you're in. So yeah, I think that's going to be sort of a cracking resource. And yeah, if you are sort of interested, got value out of the call, then definitely that book will give you loads more. And so join the wait list, and yeah, as I say, there'll be sort of free options, and if you don't get those, there'll be promotions, and yeah, there's going to be loads of opportunities in that.
Yeah, awesome, mate. So everybody, check out Sol there with LinkedIn. He's got a lot of value, so connected him there, as well as getting that free access to the book. It sounds like it's going to be awesome. I'm sure much more than what he's had with the time that we've shared with us today. It's been a pleasure interviewing you, mate, and thanks for being on the Business Growth Show.
Yeah, thank you so much for having me on. I've loved being here, and I've loved answering your questions.
Thank you, everyone, for watching and listening to this show where we talk about everything on business growth. And please like, subscribe, and leave us a 5-star review. You can find me on LinkedIn, Facebook, Instagram, and YouTube as Ethan Casiotis, or visit my website, ethancasiotis.com. If you want to grow and scale your business, you can reach out to me on any platform to see if we're a good fit. I completely agree with you, or do I? The only way you know is if you tune in next time. So until next time, remember that our business grows when we learn skills and take action using them in spite of fear. So remember to design your growth and results.